we have another guest in the studio, a young Nigerian, Lukman Otunuga. In the studio this morning. He's a research analyst at FXTM. Good morning. How are you?
Good morning. I'm great. Thank you for having me here today. It's a pleasure.
Naya, did you hear that voice? Did you hear that voice? Did you hear? All right, he's here to talk to us about Nigeria economy and all things on the pipeline this morning. So what picture can you paint for the Nigeria economy for H1, and what is your outlook for the rest of the year?
Well, the first half of the year has been quite interesting, for Nigeria and globally. Taking a bird's eye view of Nigeria's economy, interestingly, we've managed to stay afloat. If you look at GDP growth, it's been 1.95%. Inflationary pressures have eased. The Naira has been interestingly stable. The foreign exchange reserves remain robust. So based on these factors alone, the first half of 2018 has been great for Nigeria. But then when we look towards what the second half of the year holds, it's quite interesting because Nigeria could find itself pincered by both domestic and external factors. So domestically, we know that next year we have the elections. So election risk could create uncertainty and spark risk aversion across Nigeria. Outside of Nigeria, we know that the Federal Reserve will be raising interest rates at least 2 more times this year. Now, we've said this many times, although the dollar is not the legal tender in Nigeria, it still has a strong weight. So a stronger dollar, of course, will naturally impact Nigeria. So Nigeria's economic outlook depends on how the nation reacts when the Federal Reserve raises rates, and also how investors in Nigeria react to the political situation brewing ahead of the elections in February 2019.
Right. Okay. So inflation seemed to be moderating. Can we enter single digits? And what does this mean for the man on the streets?
So yes, when we look at inflation in Nigeria, we can see that inflationary pressures are slowly becoming a theme of the past, meaning the recent inflation levels was around 11.23% compared to the high levels of 18-19% that we saw sometime last year. So my thoughts on inflation, if it wasn't for the presidential elections, I would have thought that inflation in Nigeria will continue to moderate to possible single digits. But we may have a cost-push inflation scenario where election spending boosts prices, and because of this, inflation could rebound. But before inflation rebounds, for the man on the street, the falling inflation levels, it's good news, They have more change in their pockets, they have a stronger purchasing power, and we know that consumption is one of the factors that support growth. The man on the street has more naira to consume. Of course, this could positively impact growth in Nigeria.
Right. So when do you expect the CBN to cut interest rates?
So to cut or not to cut, that has been the ongoing question.
Right.
So initially, my evaluation was the CBN would probably take action and bite the bullet and cut interest rates to 12% by the end of the year. But as I've said earlier, the situation in Nigeria domestically and external factors could force the CBN to reevaluate this. So domestically, as we said earlier about inflation, so one of the main reasons why the Central Bank of Nigeria has held off in cutting interest rates is simply because of inflation. Right. They were waiting for inflation to hit single digits before taking action. But because of the election coming up, with inflation rebounding, this could actually force the CBN to maintain status quo. Outside of Nigeria, we've said earlier that the Federal Reserve is expected to raise interest rates in September and December. So if we have a situation where the Bank of America, the Federal Reserve, is hiking interest rates, and the Central Bank of Nigeria goes forward to cutting interest rates, this will simply widen the monetary policy divergence between both major central banks. Meaning, such would result in an acceleration of capital outflows from Nigeria, and this is bad news. This will negatively impact Nigeria's economy. So, for the Central Bank of Nigeria to move forward and bite the bullet to actually cut interest rates to promote growth at the end of the year, we need to see how economic growth, GDP for second quarter, prints out at the end of this month. We need to see further signs of inflation easing before the cost push scenario kicks in. And most importantly, we already know that Nigeria's fortune remains tied to oil. So if poor oil prices remain at the elevated levels, this could also provide enough buffer for the Central Bank of Nigeria to cut interest rates at the end of the year.
Okay, with the U.S. imposing sanctions on oil, what is the outlook for the commodity and how can this impact Nigeria?
A very good question. So the sanctions that the United States are imposing on Iran, of course, would fuel speculation of lower supply of oil in the markets. And it's a supply and demand dynamics. So as Economics 101 teaches us, when supply falls, naturally prices increase. And this is why oil prices are trading where they are right now. However, I think I've said before that the main reason why oil prices are at their current levels is simply based on geopolitical risk factors. So let me break this down. Geopolitical tensions in Saudi Arabia, of course, the prospects of sanctions for Iran have created speculation of less supply in the markets. However, we have to keep in mind that production from US shale remains robust, and with global trade tensions still a major theme everybody's talking about, this could negatively impact demand for oil, meaning oil prices have scope to trade low. So now going back to Nigeria, how does this impact Nigeria? Well, we know that, as we said earlier, Nigeria's fortunes remain tied to oil prices. When oil prices are good, Nigeria is doing well. But when oil prices are lower, the government has less money to spend. And of course, this would impact the Naira's exchange, price stability, and economic growth.
Right. So global trade tension remains a key talking point across financial markets. Are we heading for a global trade war?
This is a very, very interesting question that everyone across the global markets have been asking. Well, recently we've seen that tensions between the United States and China remain heightened. So there's a tit for tat going on where both nations are actually imposing sanctions on each other. Now, this ending in a trade war, it's a question nobody knows. But what I do know is the uncertainty that it creates may negatively impact global growth and stability.
Okay. What is your outlook on dollar, pound, and euro?
So coming from the United Kingdom, of course, the pound, I've seen how the pound has been hammered, and the reason why the pound remains weak is because of the Brexit. So Brexit uncertainty has been a major talking point in the United Kingdom, and as long as uncertainty continues to persist, it's going to haunt investor attraction towards the pound. Now, looking at the dollar, my outlook for the dollar is bullish. The dollar remains king across currency markets. The reason why the dollar remains strong and robust is, number one, sentiment or confidence remains quite bullish towards the US economy. Number two, as we've said earlier, the fact that the Federal Reserve is going to raise US interest rates 2 more times this year is heavily supporting the dollar. And finally, as we said also, with global trade tensions creating risk aversion and uncertainty, investors have seemed to be rushing towards the dollar as a safe haven asset. So my outlook for the dollar remains bullish. And finally, with the euro, so for those who watch the European Central Bank has said that interest rates in Europe will not be increased till summer 2019. So when we compare this to the dollar with the Fed, which was expecting higher rates this year, going back to the monetary policy divergence between the European Central Bank and the Federal Reserve is likely to ensure that the euro remains pressured for an extended period of time.
Amazing. I would like to keep talking to you, but we're almost out of time, so I'll have to let you go. Thank you so much for coming this morning on the Morning Drive.